Picture this. It's May 6th, 2010, and the global financial system is, well, staring right into the abyss. In just a few minutes, the market went into a free fall so fast and so violent that it really seemed like the whole thing might just fall apart. So today, we're going to unpack the anatomy of the day the machines literally broke the market. $1 trillion. I mean, just try to wrap your head around that number. That's a 1 with 12 zeros after it. This wasn't some abstract financial product. This was the value of the market itself.
That's how much value, poof, just vanished from the balance sheets of the world's biggest companies. We're talking about people's retirement funds, college savings accounts, global confidence. It all just vaporized.
And here's the most terrifying part. It all happened in just 36 minutes. 36 minutes. A complete, catastrophic meltdown moving at the speed of light, while all the human traders and regulators were left completely in the dark, just scratching their heads. So, the trillion-dollar question is, how? How does a modern, super-regulated market just break? Was it a glitch, a deliberate attack, or was it something that was kind of baked into the very DNA of our high-speed financial system? Well, that's exactly what we're here to find out. Okay, so first things first, we gotta understand this crash didn't just happen out of the blue. The stage was already set. On the morning of May 6th, the market was basically a giant bundle of nerves, already incredibly fragile from a perfect storm of global fear and internal weakness. And you can see right here just how all these pressures were building up. You have major anxiety over the Greek debt crisis, which was pushing investors to sell. At the very same time, the market's own internal shock absorbers were just vanishing. And check this out. The E-mini liquidity, which is basically the pool of ready buyers and sellers, was down a staggering 55%. The very foundations of the market were becoming brittle. This created what traders call a liquidity vacuum. Here's a simple way to think about it. Normally, if you drop a rock in a deep pool of water, you just get a splash, right? But what happens if you drop that same rock into a tiny, shallow puddle? It slams right into the bottom. Well, the market was becoming a very, very shallow puddle. You know, there's actually a scientific concept for this, and it fits perfectly. It's called self-organized criticality. It sounds complicated, but the idea is pretty simple. Imagine you have a pile of sand. You keep adding one grain at a time. Nothing happens, until you add that one perfect grain of sand, and the whole thing just collapses into a massive avalanche. The market? It was that sand pile, just waiting to collapse. And that one final grain of sand, it was about to drop. And it wasn't a clumsy fat finger mistake by some trader. Nope. It was a machine, an algorithm that was just doing exactly what it was programmed to do. So at 2:32 p.m., an investment firm called Waddell & Reed had to sell a huge position. We're talking $4.1 billion worth of stock market futures. They flipped on an automated selling program to do the job. But, and this is a huge but, this algorithm had a fatal flaw. It was designed to sell its shares based on one thing and one thing only, trading volume. It didn't care about price, it didn't care about time, just volume. And this is where things get really wild. It created this disastrous feedback loop. Think of it like a game of hot potato on hyperspeed. Here's what happened. The algorithm sells a batch of contracts. High-frequency trading bots instantly buy them, then try to flip them a millisecond later. This insane back and forth massively inflated the trading volume. So the algorithm from Waddell & Reed sees this huge fake volume and thinks, wow, the market is super active, I gotta sell even faster, which created this vicious downward spiral. And if you want to see just how nuts this feedback loop got, just look at this. Between 2:41 and 2:44 p.m., the institution actually sold about 2,000 contracts. But because of that frantic hot potato game, the total trading volume exploded to look like 140,000 contracts. The algorithm was basically chasing a ghost that had created itself, dumping billions of dollars into a market that had no real buyers left. But wait, it gets even crazier. The runaway algorithm, that was the catalyst, sure, the avalanche had started. But there was someone else out there, actively pouring gasoline on the fire. And get this, he was doing it from his parents' house in a suburb of London. Let me introduce you to Navinder Singh Sarao. As he put it himself, he didn't see the market in terms of companies or people's retirements. To him, it was all just a big computer game. And on May 6th, he was playing to win, with devastating effect. So Sarao was an absolute master of this manipulation technique called spoofing. He had custom-built software that would place these enormous sell orders into the market, orders he had zero intention of ever actually filling. This created a giant fake wall of selling pressure that would spook other algorithms into selling for real. His program was so smart, it would even tether his fake orders to the real market price, making sure his phantom wall was always in the perfect spot to cause the most chaos.
So, what did he get for helping to push the market off a cliff? Almost $900,000 in a single day.
But this is where the story takes a really strange turn. Sarao wasn't your typical Wall Street villain living some lavish lifestyle. The guy was diagnosed with Asperger's syndrome, he lived in his childhood bedroom, and he reportedly used coupons to buy food. He eventually lost almost all the millions he made to a bunch of con artists. And because he cooperated with authorities and because of his unique circumstances, his sentence was just 1 year of home confinement. He was this ghost in the machine, but a much, much more complicated character than anyone could have guessed. So how in the world do you stop a market that's in a free fall at the speed of light? The answer, believe it or not, was ridiculously simple. A 5-second pause. At 2:45 p.m., a single automated circuit breaker on the Chicago Mercantile Exchange, called Stop Price Logic, finally kicked in. It saw prices dropping at this impossible speed, and it just hit pause on trading. For 5 seconds. That's it. But that tiny 5-second breath was all it took. It broke the hot potato feedback loop, it stopped the runaway algorithm, and it gave the humans just enough time to look at their screens and say, wait a minute, these prices are insane. After the dust settled, it was a mad scramble to build better guardrails for this new high-speed world. And the changes were huge. Before the crash, you had these slow, clunky circuit breakers designed for a whole day of panic. Afterwards, we got new rules like limit up, limit down price bands that can halt a single stock in seconds. And those absurd 1-cent stub quotes that stocks were hitting, banned. The whole system got a fundamental upgrade. And that brings us to the big, unsettling question we're left with today. The flash crash was a massive wake-up call, for sure. But our markets now, they're exponentially faster, more complex, and more interconnected than they were back in 2010, driven by AI that we barely understand. We might have patched the specific cracks that caused that 2010 avalanche, but have we done anything to make the mountain itself any more stable? That is the real trillion-dollar question.